After briefly dropping its hawkish stance in the face of a potential banking crisis, the European Central Bank has reverted back, promising to continue its monetary tightening campaign through the next few months. We think that doing so in the face of a budding recession and weak outlook means it's very likely to over-tighten monetary policy, which we view as a negative for European equities. How should investors position for this scenario? Let's take a closer look. When a central bank over-tightens, it hikes interest rates too high, too fast, and keeps them there for too long. In doing so, it hurts the economy beyond what is necessary to bring inflation down and potentially sows the seed of a future disinflation problem. In our opinion, that's the path the ECB is currently on. By focusing almost exclusively on lagging and backward-looking data such as core inflation and wage growth, the ECB is seemingly missing the significance of a weak economy and steep declines in leading inflation data. As a result, we have to assume Europe's economy and financial markets face a difficult combination of recessionary growth and hawkish monetary policy. By its own admission, the ECB understands that it has misfired substantially in terms of its economic projections. But with inflation expectations firmly anchored and falling credit growth showing the monetary policy transmission channel is working, the ECB has the option to exercise patience. We think the reason it doesn't is because its projections are too optimistic on growth and too negative on inflation. And by the time enough data has come in to adjust its outlook, we think it will have already over-tightened, hurting the economy and spooking investors. With our outlook of a weak economy and aggressive monetary policy, we decided to reduce our allocation to European equities to an underweight position in our global policy model, which guides our multi-asset portfolios. This falls in line with our pre-existing underweights to US and emerging market equities. We added to investment-grade bonds to lower our overall risk-taking. We continue to prefer to take risk through overweight positions in high-yield bonds and natural resource equities, and we maintain an underweight to duration in the fixed income market.